Is Johnson & Johnson, a well-known dividend king, worth your investment despite its recent decline? That's a question many are asking, as the company's stock price has seen a dip of around 9% over the past year and 7% year-to-date. Currently trading near its 52-week low of $143.13, the stock price is hovering around $146.66. These numbers, however, are not the whole story. Johnson & Johnson has recently increased its dividend by 4%, raising its payment to $1.24 per share. This move is a testament to the company's commitment to shareholder returns, even in the face of a challenging market. Yet it raises a question. What's driving this decline, and is it a temporary blip or a sign of things to come? In this video, we will delve deeper into the reasons behind these numbers and whether Johnson & Johnson holds value for investors. Let's start by talking about Johnson & Johnson's dividend metrics, which may interest potential investors. Johnson & Johnson has a starting dividend yield of 3.38%. This is the highest it's been in a decade, with the only exception being March of 2020. This is noteworthy because a high dividend yield can be a sign of a company's commitment to returning capital to its shareholders. Now, let's talk about the payout ratio. This is a measure of the percentage of earnings a company pays out to its shareholders in dividends. Johnson & Johnson's payout ratio stands at a reasonable 33.5%. This means that the company retains over 2/3 of its earnings, which it can use for future growth, paying down debt, or other corporate purposes. Additionally, Johnson & Johnson's free cash flow payout ratio is 64.5%. This metric is similar to the payout ratio, but instead of earnings, it uses free cash flow. Free cash flow is the cash a company generates from its operations, minus capital expenditures. It represents the cash that a company has available for dividends, share buybacks, and debt repayment. Finally, let's highlight Johnson & Johnson's impressive history of dividend increases. The company has raised its dividend for over 50 consecutive years. This is an extraordinary achievement, demonstrating the company's commitment to returning capital to its shareholders and its ability to generate consistent earnings growth. With these metrics in mind, it's clear that Johnson & Johnson has a strong dividend profile. The company's high dividend yield, reasonable payout ratio, and impressive history of dividend increases are all positive signs for potential investors. Yet, it's important to remember that while these metrics are encouraging, they are only part of the picture. They should be considered in conjunction with other factors, such as the company's earnings growth, financial health, and future prospects. With a solid dividend history, Johnson & Johnson certainly presents an interesting case for dividend-focused investors. Moving on, we delve into the latest quarterly report from Johnson & Johnson. This report provides a snapshot of the company's financial health and can offer insights into its future prospects. The earnings per share, or EPS, is a key metric that investors often look at. It represents the portion of a company's profit allocated to each outstanding share of common stock. In its latest quarterly report, Johnson & Johnson reported earnings of $2.71 per share. This figure surpassed expectations by 6 cents. If you're wondering what this means, well, when a company's earnings exceed analysts' expectations, it's generally a positive sign. It suggests that the company is performing better than the market predicted, which can instill confidence among investors and potentially drive up the stock price. Let's now turn our attention to the revenues. Revenues are the total amount of money a company brings in from its business activities before expenses are deducted. For the same quarter, Johnson & Johnson reported revenues of $21.4 billion, a figure that aligned perfectly with analyst predictions. This alignment is another positive signal. It means that the company's sales performance is on track with market expectations. However, it's worth noting that these figures alone don't paint the full financial picture. They need to be considered in the context of other financial indicators and the overall market conditions. For instance, how does this earnings report compare to previous ones? Is the company's revenue growing or shrinking over time? How do these figures stack up against competitors in the same industry? The answers to these questions can provide a more nuanced understanding of a company's financial performance and its potential for future growth. So, while the latest earnings report from Johnson & Johnson shows strong results, it's essential to dig deeper and consider the bigger picture. The earnings report indicates a strong financial performance, but let's dig deeper. Understanding a company's financial health is key to making informed investment decisions. And when it comes to Johnson & Johnson, there are a few critical aspects to consider. First off, let's talk about the company's free cash flow. Free cash flow is essentially the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's the lifeblood of any business and a key indicator of financial health. For Johnson & Johnson, the free cash flow is quite robust. It's more than adequate to cover the company's dividend payments, which is a positive sign for investors looking for a steady income stream. But here's where things start to get a bit tricky. While the current free cash flow is healthy, we need to take a closer look at the company's growth rate. The growth rate is a measure of how quickly a company's earnings are increasing. This rate has implications for the company's ability to continue increasing its dividends in the future. Now, Johnson & Johnson has a long history of raising dividends, over 50 consecutive years to be precise. But the company's current growth rate is causing some concern. The rate of increase is not as robust as we'd like to see, and if this trend continues, it might not be sustainable for the company to keep raising dividends at its current pace. So, what does this mean for potential investors? Well, it's not all doom and gloom. Johnson & Johnson is a well-established company with a solid track record. However, it's essential to keep an eye on that growth rate. If it doesn't improve, it could signal trouble down the line. Investors therefore need to weigh the steady income from the dividends against the potential risk of slowing growth. It's a delicate balance, and one that requires careful consideration. While the company's current financial health seems stable, the future growth rate is a concern that needs addressing. This doesn't mean you should immediately rule out Johnson & Johnson as an investment, but it does mean that you need to keep a close eye on these financial indicators. How Johnson & Johnson allocates its capital and its business segments are crucial to its long-term success. Johnson & Johnson isn't just a household name, it's a powerhouse in the healthcare industry. A significant part of its success comes from its strategic capital allocation that focuses on two key areas: organic growth and dividends. Organic growth is a core focus for Johnson & Johnson. By reinvesting profits back into the company, it nurtures the development of new products and services, fostering internal growth. This is a sustainable approach that has seen the company launch innovative solutions that meet the ever-evolving needs in the healthcare sector. On the other hand, Johnson & Johnson is committed to rewarding its shareholders. The company has a remarkable track record of over 50 consecutive years of dividend increases. This consistency is a testament to the company's strong financial health and its commitment to returning capital to its shareholders. Now let's delve a bit deeper into Johnson & Johnson's dedication to research and development, often abbreviated as R&D. This is where the company really shines. In fact, a substantial chunk of its capital goes into R&D, fueling innovation and maintaining its competitive edge in the market. Johnson & Johnson operates in three business segments: consumer health, pharmaceuticals, and medical devices, also known as medtech. Each of these segments benefits from the company's hefty R&D investments. In the pharmaceuticals segment, for instance, Johnson & Johnson's R&D efforts have resulted in the development of breakthrough drugs that have made waves in the healthcare industry. The medtech segment, on the other hand, has seen the launch of cutting-edge medical devices that have revolutionized patient care. In a nutshell, Johnson & Johnson's focus on organic growth and dividends, coupled with its significant investment in R&D, is a robust strategy that not only ensures the company's longevity, but also its dominance in the healthcare industry. Johnson & Johnson's heavy investment in R&D may well be the key to its future success. However, no investment analysis is complete without considering the legal challenges and potential risks. Let's shift our focus for a moment from the numbers and the financials to the legal arena. As with many large corporations, Johnson & Johnson is no stranger to lawsuits. Some of these legal disputes have the potential to significantly impact the company's bottom line, and by extension the dividends it can offer to its shareholders. So, it's essential we shed some light on these issues. One of the most significant legal challenges faced by Johnson & Johnson in recent years involves claims related to talcum powder products. Allegedly, these products have been linked to an increased risk of ovarian cancer. Thousands of lawsuits have been filed against the company, with plaintiffs arguing that Johnson & Johnson knew about the risks but failed to warn consumers. This is not a small issue. In fact, it's led to some of the largest product liability awards in history. In one case, a jury awarded $4.69 billion to 22 women who claimed that Johnson & Johnson's talcum powder products caused their ovarian cancer. While this award was later reduced to $2.1 billion on appeal, it's still a staggering sum. To mitigate the financial and reputational risk, Johnson & Johnson has proposed a settlement plan. This plan would allocate a total of $3.9 billion to resolve the majority of the talcum powder lawsuits. A significant sum, indeed, but one that would bring some degree of closure to this long-standing issue. However, it's important to note that this is not the only legal challenge the company is facing. Johnson & Johnson is also involved in legal disputes related to its opioid products, surgical mesh, and other medical devices. For instance, the company has agreed to pay up to $5 billion as part of a nationwide settlement over claims that it fueled the opioid crisis in the United States. This is another example of how legal challenges can result in significant financial obligations. So, what does this all mean for investors? Well, it's a reminder that investing always involves some degree of risk. It's also a reminder that large corporations like Johnson & Johnson can face substantial legal challenges that can impact their financial health. While Johnson & Johnson has a strong cash flow and a long history of dividend increases, these legal issues pose a potential threat. The company has set aside significant funds to cover these liabilities, but if additional lawsuits arise or if current lawsuits result in higher than expected settlements, the company's financials could be significantly impacted. In conclusion, as an investor, it's important to keep an eye on these legal issues and consider them as part of your overall investment strategy. Remember, investing isn't just about the numbers, it's also about understanding the company you're investing in and the challenges it faces. These legal challenges could potentially impact Johnson & Johnson's financials significantly. Now that we've looked at the key factors, let's summarize our findings. We've taken a close look at Johnson & Johnson, a respected dividend king that has been trading near its 52-week low. A decrease of approximately 9% over the past year and 7% year-to-date raised some eyebrows, prompting us to delve deeper into the company's financial landscape. We kicked off with dividend metrics, revealing that Johnson & Johnson currently boasts a starting dividend yield of 3.38%. This is the highest it's been in a decade, save for a spike in March of 2020. The payout ratio is reasonable, standing at 33.5%, with a free cash flow payout ratio of 64.5%. It's worth noting that Johnson & Johnson has a commendable track record, having increased its dividends for over 50 consecutive years. Next, we analyzed the company's latest earnings report. The report showed earnings of $2.71 per share, beating expectations by 6 cents. Reported revenues aligned with analyst predictions, coming in at $21.4 billion. These numbers give us a solid understanding of the company's current financial health and its ability to meet market expectations. When it comes to financial health and investment, we noted that Johnson & Johnson's free cash flow is sufficient to cover dividend payments. However, there's a slight cause for concern regarding the growth rate. If this doesn't improve, it may pose a challenge for future dividend increases. In terms of capital allocation and business segments, Johnson & Johnson appears to prioritize organic growth and dividends. The company invests heavily in research and development, a strategy that is key to their long-term success. This is particularly true for their pharmaceutical and medtech segments. But of course, no analysis would be complete without considering the potential risks. We discussed various legal challenges facing Johnson & Johnson. One of note is a significant settlement related to talcum powder claims, which could potentially have a severe impact on the company's financials. So, where does this leave us? Well, Johnson & Johnson certainly has a lot going for it. There's the robust dividend history, strong financial performance, and a clear commitment to research and development. But it's not all smooth sailing. The growth rate needs improvement, and the ongoing legal challenges cannot be ignored. While Johnson & Johnson presents a robust dividend history and strong financial performance, potential investors must consider the possible risks, including the company's growth rate and ongoing legal challenges. The key to successful investing is balancing potential rewards with potential risks, and this case is no different. So as always, due diligence is essential before making any investment decisions. That's it for our deep dive into Johnson & Johnson. We've examined the company from various angles, and now we'd love to hear from you. What are your thoughts on the company's financial health, dividend metrics, and the potential risks we've discussed? Do you think Johnson & Johnson is a good investment right now? Please share your thoughts and comments below. And if you found this video informative and want to stay updated with our in-depth analysis of various companies, don't forget to hit that subscribe button. Your support helps us to keep delivering quality content. Thank you for watching, and remember, investing is a journey, and we're here to help you navigate. See you in the next video.